Now speaking, Robin Halpern, Vice President and Head of Investor Relations. Good morning and thank you for joining us. I'm here with James Quincy, our Chairman and Chief Executive Officer, and John Murphy, our President and Chief Financial Officer. We have released our quarterly earnings report, which includes an analysis of our growth and operating margins. Our report also contains forward-looking statements, including statements concerning long-term earnings objectives. Our report is available on our company website at coca-colacompany.com. In this call, we will discuss our financial performance and provide insight into our future plans. We will also take questions from the audience. Please limit yourself to one question and re-enter the queue if you have more than one. Now, I'll turn the call over to James. Now speaking, James Quincy, Chairman and Chief Executive Officer. Good morning, everyone. After a strong start to the year, we continued our momentum in the second quarter. We delivered 11% organic revenue growth and gained value share in both at-home and away-from-home channels. We are raising both our top-line and bottom-line guidance today. We are seeing strong engagement from consumers across our staple of brands, including Coca-Cola, Sprite, Fanta, Fresca and Tums Up. We are driving quality leadership throughout our portfolio by leveraging our scale to drive efficiencies, connecting consumers to passion points and personalized experiences, and providing affordable and premium propositions. Despite macro forces such as global inflation, currency devaluation, and shifting consumer needs, our business is proving to be very resilient. We have many levers to pull to manage successfully through different operating environments, and we remain consumer-centric and focused on growth. We are confident in our ability to deliver our long-term objectives, which include pursuing excellence globally and winning locally through relentless consumer centricity to drive top-line momentum, investing for the long-term health of our business and raising the bar across all elements of our strategic flywheel, and generating US dollar EPS growth. Now speaking, John Murphy, President and Chief Financial Officer. Thank you for joining us today. We are pleased to report strong second quarter results, with organic revenue growth of 11%, unit cases flat, concentrate sales up 1 point, and price/mix growth of 10%. Comparable gross margin was up 40 basis points, and comparable operating margin expanded 90 basis points. This resulted in second quarter comparable EPS of 78 cents, up 11% year-over-year despite a 6% currency headwind. Free cash flow was approximately $4 billion year-to-date, largely attributable to strong underlying operational performance and working capital benefits. Our balance sheet is strong, and our net debt leverage of 1.6 times EBITDA is below our targeted range. We are encouraged by what we are seeing in the marketplace and have numerous levers available to drive top-line growth and improve the effectiveness and efficiency of our spend over the long term. We have raised our 2023 guidance to organic revenue growth of 8% to 9%, positive volume growth, and currency-neutral earnings per share growth of 9% to 11%. We expect pricing in developed markets to moderate through the year, and inflationary pressures are beginning to moderate in some ways. We continue to expect per-case commodity price inflation in the range of a mid-single-digit impact on comparable cost of goods sold in 2023. Our updated underlying effective tax rate for 2023 is 19.3%, and we expect to generate approximately $9.5 billion of free cash flow in 2023. We are confident in our ability to deliver on our guidance for 2023 and drive value for our stakeholders over the long term. Bank of America Merrill Lynch analyst Brian Spillane inquired, "What changes have you seen in the macro environment and operating conditions since the start of the year, and how has that impacted organic sales growth in the back half of the year?" James Quincy replied, "Good morning, Brian. We're executing our strategy as planned and expect to see positive volume growth in the second half of the year. We have 3 buckets of price/mix impacting revenue, carryover from last year, price increases this year, and higher than expected pricing in countries with high inflation. We anticipate these buckets will result in a normal year for pricing." James Quincy replied, "Volume in the second half of the year is expected to be similar to the first half, whether compared to prior year or 2019. Pricing is composed of 3 buckets: the carryover, which is stepping down to 0 by the end of the fourth quarter, the new pricing that is consistent with normal levels and in place for the year, and the third bucket, which is about a quarter of PMO, is higher inflationary countries. We expect some of these inflation rates to moderate in the second half, resulting in a Forex headwind. This composition should deliver good top-line growth in the second half. Next question, operator. Barclays analyst Lauren Lieberman inquired, "How is coffee fitting into the resource allocation model and profit pools, particularly in the UK? Are the improvements in Costa UK due to recovery with mobility, COVID, or strategy adjustments?" James Quincy replied, "Q2 has been more of a recovery than new stages of growth for our company. Express machines have continued to expand numerically, and the B2B business in the UK has been strong and still growing. In terms of retail stores, we are focused on driving growth going forward. Internationally, we have made good progress in China and Japan with ready-to-drink Costa and Georgia. We are also seeing traction in Europe and the US with our B2B business, which includes express machines and beans. Morgan Stanley analyst Dara Mohsenian inquired, can you provide more clarity on the confidence internally around top-line performance given the weaker start in April and stronger June volume? Is the guidance range for full-year organic sales growth based on upside from Q2 and/or Q1? James Quincy replied, in Q2, April started off softer than expected, but things normalized by the end of the quarter and June was a good month for growth. Taking into account the combination of good, middling and bad months from January to June, we expect a similar growth rate in the second half of the year. We don't anticipate any substantive new pricing in the downhill, and we feel confident in our outlook for the full year, which is why we're increasing our guidance. It's always best to take a multi-quarter average when considering volume, pricing or EPS, as this helps to avoid getting too distracted by any given quarter's ups and downs. Goldman Sachs analyst Bonnie Herzog inquired, what headwinds are impacting Asia-Pacific operating margins and what initiatives have been implemented to mitigate them? James Quincy replied, in Asia-Pacific, there were some atypical factors in Q2 that depressed the margin, such as destocking in China and strong demand for juice businesses in China and India. There is also a structural headwind due to the geographic mix effect of Japan's higher operating margin compared to the lower price points of emerging markets like India and China. We strive to offset this headwind through our strategies, marketing, RGM execution, and investments. While the margin fluctuates, it has had a certain stability when looking at 2019 versus 2022. We manage it as part of the overall portfolio to hit the top end of the revenue with a little bit of aggregate operating income margin expansion for the total enterprise. Deutsche Bank analyst Steve Powers inquired, what opportunities exist to balance top-line growth and margin expansion, and how has the below-the-line deleverage outlook changed for the full year? John Murphy replied, Steve, in the quarter we saw higher equity income and interest earned on our overseas cash, which was ahead of our expectations. We don't anticipate that level of performance in the second half of the year, so there may be some slight deleverage. James Quincy replied, North America's top line and margin results were strong in the second quarter, due to a number of timing factors. These included a faster growth rate in the away-from-home market, which is margin accretive, as well as the body armor integration. Going forward, we will continue to focus on top-line growth with small incremental operating margin expansion. We will achieve this through effective resource allocation, such as marketing and operating expenses, as well as RGM strategies that create sales with higher gross margins. Evercore IC analyst Rob Ottenstein inquired, what strategies are you implementing to ensure that bottlers remain focused on products that create the most value for the Coca-Cola Company? James Quincy replied, at our global bottler meeting last week, we had a clear alignment on what needs to be done to drive our collective business forward. We discussed how to enhance our relationships with retailers, particularly in the fragmented channel, through B2B platforms. These platforms have been tested and explored in Latin America and have shown an improvement in both the relationship and sales. We are committed to experimenting and being on the front edge of what drives value in the marketplace. Wells Fargo securities analyst Chris Carey inquired, can you provide more detail on the private label switching happening in certain markets? Where are you seeing this geographically and by category? What is your playbook for responding to these actions? How do you plan to price against inflation in these markets? James Quincy replied, private label switching is primarily seen in Europe and the US, and to a lesser extent in Latin America. It is highly dependent on the strength of the brands in a particular category, with beverages such as water and juices being more affected than soft drinks and colas. Our strategy to combat this includes marketing to make the brands relevant to consumers, as well as RGM strategies such as premiumization and affordability. Inflationary environments have been well learned in Latin America, and we are now applying these strategies in Europe and the US in markets where we price for local inflation. The risk of not following inflation is low, but the risk of volume decreases is higher. We have long-term relationships with most providers and hedging programs to help manage pricing and packaging. Citi analyst Filippo Falorni inquired, can you provide more insight into your alcohol strategy, particularly with Red Tree beverages? What new innovations and subcategories are you exploring to expand in this area? James Quincy replied, the Red Tree entity we set up in the second quarter is more of an optimization than a change in strategy. It allows us to better coordinate and influence marketing with our U.S. partners and separate alcohol from non-alcohol brands. It's still a small part of the business, but Jack and Coke and Simply Spiked Peach are performing well in the US and the Philippines. Jack and Coke and Lemon Dough have achieved over 30% share of the RTD category. We're pleased with the progress so far and encouraged about the next steps. JP Morgan Chase & Company analyst Andrea Teixeira inquired, what is the performance of EMEA ex-Russia and how should we be thinking about it going forward? How is on-premise performing against off-premise globally? James Quincy replied, EMEA was a bit soft in the second quarter due to the withdrawal from Russia, but Europe ex-Russia was positive in the first half. We're expecting EMEA to be positive in the second half, with the potential for some effects from hyperinflationary countries like Turkey and Pakistan. Away-from-home consumption has been growing faster than at-home consumption in the recovery, and globally transactions are ahead of volume, suggesting smaller packages are growing faster than larger packages. This is likely the last bit of renormalization post-COVID, rather than a new secular trend. UBS analyst Peter Grom inquired, James, do you expect any changes in the promotional environment in North America? How do you see channel mix evolving as consumers seek more value in developed markets? James Quincy replied, the U.S. pricing and promotional environment is rational. We have strategies in place to balance our premiumization, regular, and affordability strategies, which includes a little more promotion than the first quarter. We believe we have the right mix of promo and price to gain volume and value share in the U.S. and developing markets. We are seeing a renormalization post-COVID, not recessionary or inflationary. We don't expect channel mix to be a major feature of the discussion in quarters and years to come. James Quincy replied, yes, thank you. Our second quarter results show the progress we are making in the marketplace. We are managing a variety of local market conditions while also achieving scale and staying agile on a global level. We are confident that we will meet our 23 guidance and our long-term goals. Thank you for your support and for joining us today.